What is your opinion on around what Trump is doing with all these tariffs that he's putting on, these policies and all these changes he's applying?
At the beginning, I can be positive. I can understand his concerns about a huge deficit, trade deficit. But I don't believe that that's the right policy. First of all, to blame the other countries that actually now they produce more than you and they give you their products because you actually invest on these countries. And for example, now in California, they make an R&D about iPhone, but on the other hand, they produce iPhone in China. And actually now Trump blames China. And then they put some tariffs.
But we're talking about different things here. The tariffs between two different countries and then production. And I'm not too sure about this, but is Trump hell-bent on everything needs to be produced only in America? Or is it linked to the tariff discussion? Or are these two different discussions? So for example, in the iPhone, so China, most of the chips and whatever they're producing, they've got the resources and they're created, the iPhones are created in China. To create the same factories and plants and whatever in the US, I think is a massive task. It's super challenging. I think there's a massive challenge there. And so my question is, because I really don't know, the question here is Trump, what is he after? Is he after creating everything in-house in the US? Or does he just want fair trade between the two countries? Like, whatever you charge me, China, I will charge you. And you can keep producing the iPhones, fine, but we're going to have matching charges. Welcome to the Financial Frontiers podcast. Remember to subscribe to our YouTube channel, hit that bell icon to get notified when we upload new content. Follow us on Spotify and give us a 5-star rating. It will help the channel, which I hope you love so much. Here we are, another episode on the Financial Frontiers podcast. My guest today is a very experienced individual in trading, portfolio management, in the markets, dating from the 90s, lived through the introduction of the internet era, lived through the pandemic, the crisis, the pandemic, the haircuts. I think we're going to learn a lot of things from Nikos Akkizidis today. Nikos, thank you for your time. Please introduce yourself and let's have a great conversation over here.
Thank you very much, Dinos. My pleasure to be here. Thank you for the opportunity to give me to communicate with your audience. As you mentioned, I'm, I can say, economist for many years, from 90s. I started as a research analyst, which was, I think, the best beginning. I think so, because I understood and I really now understand how the market acts and reacts. So it's, I think it's a good start to be at the beginning in research. Then I moved to more action paths. I moved to dealing room, to advising, and then portfolio management, of course, risk management. And then I took some other more senior positions on head of dealing room, and then I became an executive member of the board in a big brokerage firm in Athens, COO as well. And all these years also, my target was all the time to communicate with people, with investors, with not only, they are not clients, they are investors, they are traders, they are people that they want to understand what they are doing, how they can benefit with markets. So I really want to communicate. And at the beginning of my career, I started communicating, writing articles. And that time in newspapers, because there were many newspapers that time. in Greece. I've written in most of them, I think all of them, from Καθημερινή, Ημερησία, if you, some Greek people, they may understand, they may know these big newspapers. And then, of course, after internet came up, I communicated with the traders, with people, with investors, writing articles on internet. And the last more than 10 years, I write articles every week on fxstreet.com about investments, about analysis or education or ideas about how to invest, strategies, and also on crypto, on blockchain, on portfolio management, risk management. And recently I published many articles about AI, artificial intelligence, because I see that this is an entity that we should base on to grow our experience on and solutions on portfolio management advising. Also, apparently, I published a book, and it was about that time. It was 5-6 years ago. I don't remember. It was about macroeconomics, about macroeconomic policy that central banks implement in order to reduce the high level of government debt. What they do is they implement a financial pressure policy, which is what they're doing. They keep interest rates very low at the beginning, and always they keep it lower to inflation. And that in the long run, they eliminate the high level of growth. They did so this policy after the Second World War, and they do the same after the financial crisis of 2008. So they repeat this policy. This is the second time in the history of humanity that they implement this.
Can you get into the detail of this policy exactly, or what it is? So, from what I understood, you said that it's so you're not talking about the printing of money to boost the economy in a sense, because 4 or 5 years ago, that was around the period of COVID, and if I recall correctly, I think the European Central Bank and the American Central Bank, they printed trillions to help boost the economy, which helped towards, because of COVID and everything almost stagnated, the economy generally. That triggered inflation. But are you talking about this, or what policy are you exactly speaking about that happened after World War II and then the financial crisis, and then again 4 or 5 years ago? Is it around COVID?
Yeah, you have to go back in 2008 to understand what is they did, or you have to go back in the World War II. In that time, because of the huge crisis, they printed a lot of money because they have to handle the crisis, either on World War II because they want to produce guns and planes and all this stuff, so they increase their debt. Or in 2008, you see that in that time they were forced to print money to address the crisis. So when you increase at this high level of debt, then you try to find a solution. And what you do is, because of you face a period of recession, some kind of recession, then the interest rates, of course, they go down. So that's the opportunity for you. If they are down, and you keep this interest rate down, and investors, what they do, because of all this uncertainty, they keep their money. You remember that time 10 years ago or 7 years ago, most of the people, they keep their money because they were afraid on cash. They have it on deposits. Even though the banks, they gave zero interest rate. You remember?
Yes.
So because of they were afraid. The other point is, of course, and they try to, in that time, they some other people or investors, they invest on stock exchanges. That's why we experience a period that the stock exchange went up. All right. So we had the experience that interest rates were down. You got zero on interest rates, and the market went up. And so in that time, what you do as a governor, as a government, as a central bank, you try to keep interest rates very low, and inflation, and to make some kind of policy to have some kind of inflation. And in the long run, because of inflation, and after that was the COVID, and the inflation went up. And that time, in this period after the crisis of financial crisis, they issue huge amount of bonds by giving you zero interest rate. So they borrow money with zero interest rate, with zero cost. Mm-hmm. That's their policy. So the governments, they do have bonds. They issued these bonds 10 years ago that they gave you zero interest rates, and because of inflation, the debt is reducing, because what is that? That is because of GDP and inflation, the debt remains in the same level, and because of inflation and growth, the GDP to debt is reducing in the long run. Mm-hmm. That's the policy. Of course, this has a negative effect to people and entities, because they get nothing. That's why they don't like this kind of policy, because they had all these years, because they become poor, because if you keep your deposits on banks, you get nothing, and inflation goes up, growth of course goes up, but
you get poorer. Your value spend. So, what is the incentive around putting 0% on the interest rate? Is it to incentivize spending so that the economy can move? Is that the incentive?
Yeah, exactly. They want to. In that time, they had to help companies and society and to invest on public sector on so, and they implement this policy in order to get money, giving to depositors and to people that they invest on. And that time, actually, banks, commercial banks, they need or they push them. Governments, they push to buy these government bonds that they give you zero interest rate. Mm. So in commercial banks, that's why they give you as investor, as a depositor, also zero.
Mm. Otherwise, they're working at a loss if they give the...
Because that time they needed, all right, they needed this amount of money to support the economy, because they didn't have any other way. That's why after the Second World War and after the financial crisis of 2008, they need to support the economy. They need to support the other the public sector, they need to support big companies. They need to support also stock exchange because they support using that money to support stock exchange or to support. You remember Lehman Brothers and all other huge banks. So they needed money.
But then there were also these massive banks who just disappeared. The Fannie Mae, Freddie Mac.
Yeah, that's a process. Some banks disappear, but most of them you have to see the broad,
Yes,
the wide,
picture. I guess when there's a bubble of sorts, like in the economic crisis in 2008, where America is such a powerhouse where there's a ripple effect. If there's a bad America, it impacts the whole world. If there's a good America, it impacts the whole world. It is what's we've seen, and this massive crisis was so huge where it was they were giving out these loans on the fixed assets, the homes that were actually worthless, and they were, the details I just forget, but they were giving out loans again based off of the backing of these lower grade bonds, and then those lower grade bonds were backed by the higher grade bonds, and this underlying toxic flow of rubbish assets were backed by and trickled up the chain into what apparently was meant to be a solid investment, AA bonds on these assets, which were actually worthless. And I guess this reset was something that inevitably would happen. I mean, if you reach such a massive you've infiltrated basically the whole country based off of something that is not real, giving out loans and that aren't really backed by something that the bank can grab onto. There's no value in what they were just giving out these loans. And the incentive there was these people that were giving out these loans had their bonuses that they were getting for winning over contracts and giving out loans to individuals who weren't ever able to pay. And that crisis obviously cost the economy and impacted the whole world accordingly because of just the massive scale that it had reached. I actually just recently watched again The Big Short, that film, The Big Short.
The problem was that the core problem, we try to find why this crisis started in 2008. It was, you have to go back to 2000, and because of them, and probably after the fell down of the wall of between the East and West, because in that time what we saw and we see now is that many other players around the world they came into action. That means that you see after 2000, especially after the new century, new powers they grew up, like China. Not only China, all Asian countries, and also the East European countries. They get involved into the capitalism, so they grew up. So they become more stronger and stronger, and they increase their GDP level in a huge percentages. So in that time, what the traditional West countries like USA, they need to find some kind of solution, because they found out that many of their companies, they went abroad, they went to China, they went to Eastern European countries from Germany, they went to Czech Republic or to Poland or whatever. So in that, to keep a growth sustainable in the United States, they need to that's why they printed money. That's why they invent this kind of approaches for subprime loans and all this stuff. So it was a historical reasons, and it was because of many other countries they get involved in the global economy. So if you are a mature economy like United States or Germany or West European countries, you need to find some kind of solution, and the easiest solution is to print money, because otherwise you're gonna have a social problems.
But isn't that almost like sweeping under the rug an underlying problem? If you're just printing money.
Yes, it is, but
you're pushing the problem to the next generation.
Yes, but that's a problem. You see, now the problem is that you have to have a strategy to see forward 20 or 30 years forward. Not just 5 or 10 years.
Yes.
The governments, they must do this. But even now, they don't do it. Only China, if you see China, they have this perspective that they see they see the future. Their strategy is forward to 30 or 50 years forward. So, but this was not the main issue from the United States, because people, of course, you see, it's a different kind of people. If, for example, in the United States, they consume a lot. They want to have a pleasure.
Mm-hmm. Yeah,
and they have very extremely good universities, but on the other hand, they don't have a good education system for all people, compared to other countries, probably in China or in Asia, that they invest in their education system. They invest to a good education, to people to have a deep knowledge. Compare probably to the United States, that they do have. They attract. United States, they attract educated and high level and inspiring people from all around. They used to. I don't know now, but but I think they still attract.
What is your opinion on around what Trump is doing with all these tariffs that he's putting on, these policies and all these changes he's applying? What is your opinion there?
My opinion. All right. At the beginning, I can be positive. I can understand his concerns about a huge deficit, a trade deficit. All right, but it's I don't think that I don't believe that's the right policy. First of all, to blame the other countries that actually now they produce more than you and they give you their products because you actually invest on these countries. And for example, now in California, they make an R&D about iPhone, but on the other hand, they produce iPhone in China. So they are linked, they are interconnected each other. And actually now Trump blames China. You cannot, and then they put some tariffs. A part of this, of course, I totally disagree with this kind of policy that suddenly I invent some kind of formula, like this formula that he produced it, and to implement this tariff formula.
Yeah, what is it called? The reciprocal. So equal tariffs.
This is kind of insane, because you have to prove it that this works, that this worked at the past. You cannot just invent something out of nothing. And you say that because I have a huge deficit, and you cannot, and I don't think that you can be peer-to-peer, I mean case by case, because of course you may have a deficit with a country because you cannot produce, for example, vanilla. So we may have a deficit with a producer in a small country in Africa because you cannot produce vanilla and they don't want from you anything. But you can have another, at the same time, you can have a surplus with another country.
Because of the vanilla you get from one country that doesn't need anything from you, but you need only from them. Exactly. There's a deficit there, but now you've got vanilla, which you sell to another country, and now you've got a surplus there. Yeah.
But you cannot see it case by case. You can see the whole. Of course, I understand that in a summary, you have a deficit with all other countries. But you cannot, I don't think that you should punish them because they have a surplus. You have to find a solution to invest or to be attractive or to find a solution for integration or for implementation or for cooperation, to cooperate with them.
But my question is it regarded as punishment if you just match whatever taxes a country is charging you? So if I'm the US, you, whatever, Mexico, whichever, Brazil, and you have a tariff, you have a charge to me, the US, 15%. And up until before Trump got in, it was 0, let's say, or 3. It's not matching. Is it really punishment if I match you and I give you the option? If you don't want me to have any tariffs, if you reduce the charges you're giving me, I'm not an economist. I don't know. I've seen different professionals who speak about this. They say that can't work. This is economics 101. I don't understand it, but the logical, for me, what makes logical sense is whatever you charge me, I'll charge you. It's fair trade.
Yeah, that's why I said that this is insane. There is no, you cannot implement this kind of policy. It's something. All right, even if you say that, even if you think that the next day you're gonna you're gonna build, you have a huge amount of capital and you can create the enterprise that was in Mexico or in China.
And you do it in-house.
Yeah.
But I don't think it's so easy. Yes, I think there's a lot more complication.
Even though you create it suddenly in a magical way,
yes,
you have no people to support this. Because you need people that they have the knowledge to do whatever they need to do to produce a specific product. So,
but we're talking about different things here, right? We're talking about the tariffs between two different countries, and then production. And I'm not too sure about this, but is Trump hell-bent on everything needs to be produced only in America, or is it linked to the tariff discussion, or are these two different discussions? So, for example, in the iPhone, so China, most of the chips and whatever they're producing, they've got the resources and they're created, the iPhones are created in China. To create the same factories and plants and whatever in the US, I think is a massive task. It's super challenging. I think there's a massive challenge there. And so my question is, because I really don't know, the question here is Trump, what is he after? Is he after creating everything in-house in the US? Or does he just want fair trade between the two countries? That whatever you charge me, China, I will charge you. And you can keep producing the iPhones, fine, but we're going to have matching charges. I don't know. Is there something that I'm missing with this, I guess, simplified understanding of how the economies work between different countries?
What I can understand is that His strategy is that there is no strategy. His strategy is that we will see step by step.
And he's just throwing things on the wall and see what sticks and play it by ear.
Yes, he said
my
that.
goodness.
I think so. I believe so. That as I can understand, that he cannot understand anything. He wants to recreate, to build some kind of new. He challenges everything. He wants to recreate a new normality, a new reality, a new truth. He wants to give some forces to press the society to believe that this is something some kind of different policy that we'll see how we can implement it, and that's why the point is that markets they can't. I get the risk to make to see how the future is going to be. So the markets. So I see that the point is, the problem is that that's why the markets they don't trust him, because they realize that his policy is no policy, is something that we will see step by step. So if you have no, as you mentioned before, Chinese, for example, or other countries, they have some kind of policy, they have a structure, they want to go there, and they design this, they have a plan to do something. So these kind of policy and countries, you trust these countries and these enterprises, these companies, these people. If I know that you have a structure, you have a plan, and you explain to me step by step, but you explain that I can deeply understand what are the steps that you will follow, then I can trust you. In this case, you can see the President of the United States that we cannot, I don't know if others, but I cannot understand the paths that step by step, clearly, the path that needs to follow to go where and how and why. And so that's why the markets, they cannot, if they cannot trust him, that's why I see very, very difficult for markets to stabilize or to go up. So that's my view.
Yeah,
unfortunately, and it's sad because it's a huge country. It has a huge research, huge R&D, huge amount of knowledge of, especially in California or other cities. They have they are the leaders in capital markets. If you want to get some capital, if you are a massive, if you are a huge company, or if you are a middle company, you go to the stock exchange, in the New York Stock Exchange, and you get a massive amount of money. There is no other place in this planet that you can go and you can get the amount of money that you can drill in from the United States, from the New York Stock Exchange. So I think they have these competitive advantages, and now it seems that they have no structure, they have no plan. They go to, because, and I believe that the problem is that, or they think that the point is that there are other countries after 2000. That's how I mentioned, after internet, after the third and the fourth industrial revolution, everything changed. And why it changed everything? Because information, not only information, knowledge went abroad. Everywhere has access to knowledge. That was a huge step for humanity in that time. And because they got this knowledge, and because they implement some kind of capitalism, these countries, they grew up. And you see China, there is no way, there's gonna be the superpower is definitely going to overcome in terms of GDP United States in the next few years. Because if you see, it's not only the nominal amount of GDP. You can see GDP per capita. GDP per capita in the United States is probably around more than 80,000 euros. GDP per capita in China is less than $20,000.
Because of the massive population.
Can you imagine if this double?
Oh, yeah.
Yeah. Because it's low. The GDP per capita is very low still in China.
If they had a per capita the same as the US, that's 1.6 billion people at 80,000 each a head.
Yes. Can you imagine?
That's
it is gonna happen, which is okay. It's fine because it's in India. India is the next superpower.
The BRICS, right? Brazil, Russia, India,
yes.
China. S for South Africa. Yeah.
All other countries, because they do have access to knowledge. Mm-hmm. If you have access to knowledge, then you make R&D, and because now it's a huge opportunity because of AI, and people and entities all around the world, they do have access to this massive. It's a revolution. So
it's an interesting time. So let's go back to your experience. So you mentioned you're an economist. Before you got into dealing, let's call it, and risk management and portfolio management, which is an individual that knows how to trade the markets in the long term to be net positive. That's the whole idea. And most of the audience are obviously brokers and stakeholders that offer trading, make it possible for the end trader to be able to trade. And there's obviously an audience that is the actual trader who are looking to invest their money or perhaps have a high risk appetite and willing to enter and exit quick just to make a quick buck. But the underlying is there's a whole science, I guess, and there's a skill around being able to trade and be consistently profitable. And so with your experience before you moved into dealing and portfolio management, which is basically what you do is you have the knowledge to trade on behalf of other people's money. And then obviously with this knowledge before you got into that position gave you the ability to write these articles in these books that you've created and produced on FX Street, which is one of the big ones, Kati Merini, and all these massive newspapers in Greece. My question is something that you commented on before, which you had mentioned that you started out with research and basically a research role. So, and you mentioned that was the correct place to start before moving into being a portfolio management, doing portfolio management and dealing. And then obviously with your overall knowledge, the ability to write about these things. Can you give us a bit of your thought process and your opinion why it is more important to start, and just please remind me the exact role. Research and development, was that what you
research, development, analysis.
Research and analysis, that's what you said. So research and analysis. So you research the markets, obviously, and analyze, and then what do you do with that? Do you write articles, or do you produce it internally did you produce it internally for the dealers of the company? What was the role there, and why do you say that is a good place to start before moving into portfolio management?
For everyone, I think I believe that even if you invest, or even if you buy a house, or even if you buy a product, anything, or your enterprises, you're a company, you need to understand. You need to deeply understand what's going on. Otherwise, you will definitely make big mistakes. So it's fundamental to understand, to deeply understand. And otherwise, you have to understand and you mentioned about the traders and investors, clients, that they get involved in this in stock exchange or in CFDs or whatever, in all financial instruments, and they need to. Most of the times, these people they trust you because they. I think they should trust you because they found out that you know what you said. But most of the times they trust the company that you represent, which is, I think, that's not very. But I think that it's most important is to trust you because you understand what you suggest to clients. So the question is why for research is because I think knowledge is a fundamental pillar to create an environment that for everything that you do.
So I think, let me expand on the question and let's go deeper there. What is it that you were researching? What are you looking for? Are you going on the news? Are you looking at, companies' financial statements and, are you looking at macroeconomics, the import-export? Are you looking at the employment rate or the production? What is it that you're researching exactly?
All of these. All of them.
All of the above.
Yes, but the point is that sometimes, for example, during the COVID, I was with other colleagues, and they told me that's the perfect storm. That's going to be a totally mess. And I said to them, and because sometimes you have to challenge these huge announcements that it is a perfect storm. I said to them, I don't think so, because you have to understand. We have to understand that this is not the economic reason. This is another reason.
Mm-hmm.
That of course the economy and the markets and everything is gonna be influenced in a bad way, and you will see for some quarters a big probably recession. But you have to find the core. The core is all the time you need to find, I think, what is in economic perspective. If there are indicators really economic or enterprise in your company, if you find an indicator that really affects your enterprise, that will have an influence in your company. Otherwise, if it's external, then you can address it, you can handle it. So my view is that, of course, it's a broad concept that the traders and the client, the people that they listen to us, they need to understand that every time it's different, and every time you need to concentrate on different indicators. And sometimes it's and depends of the financial instrument you invest on. So, for example, it's different to invest on bond markets, it's different to invest on stock market, or it's different to invest on CFD market. For example, in CFD market, because it's a future market, it's a zero-sum game, you have to concentrate, as a researcher, as an analyst, you have to concentrate on the strategy that you follow, on the hedging or arbitrage, or on the risk management. And so this is the main concept, because it's not, you cannot measure that I get a trade on euro against the USD and for example long position for the next few minutes, for the next few hours, and you concentrate on the macroeconomic factors broadly. Of course, you can mention that probably we have an announcement. But even with the announcement, you need to really understand what this, or an announcement or an indicator, you really understand what this indicator actually tells to the market. If the markets, because all the time the markets they have some kind of perception about the indexes that they will the indicator that will announce, for example, about inflation, about GDP, whatever. So I think also it's case by in that point it's case by case. Of course, in a broad way, but in case by case. So the traders. That's why I think I have another approach about the traders. We can talk about what they should do, what they get involved. I think they should follow some kind of steps. We can discuss about the steps.
Yes, please share. What kind of advice can you give traders?
Yeah, I can give. I think that in trading there are 3 different levels, and I think there are 7 different steps that investors and traders should follow all the time. And I believe that all traders, all investors, all of us in any activities in our lives, you have to follow such kind of paths, and you have to follow some kind of story, and to follow this story. So first of all, for traders, my advice is to start with self-awareness. We have to understand what they really they first of all, the first level is to be prepared. And be prepared means that they understand what they are. They should understand their risk appetite, their level of amount of money that they will invest or they will trade. They will ask to themselves, do I understand this kind of market? What is my experience? What is my knowledge about this market? And compliance-wise, do I understand? Do I know my rights? How can communicate with a company? So, and they have to find their profile. They have to build their own profile to understand who they are, what they want to do, why they came to this market, to a specific market, what they want to. They want a long-term returns or short-term returns, and to decide that this is the structure, this is the strategy that I will follow, and to talk about to the company or to advisor that they are communicate. So first of all, they have to understand themselves, their needs, their views. All right, that's the first one. The second step to be well prepared is to really understand the instruments, the financial instruments that they invest on. It's a different story if you invest, as I mentioned, in the bond market. It's a different story if you invest in stocks, on future market, on CFD market. They have to really understand their specific characteristics of them, because each of a financial instrument has different characteristics.
Right.
The first step is to be well prepared is to understand the market. It's a different market. The stock market is a different market. It's all. If you invest in the US, or if you invest to China, if you invest to different regions, if you invest to different countries. Then they have to, the second level is that they have to, it's like a company, it's like in our lives. You have to understand ourselves, you have to understand your company, and then you have to find out how you will improve your company, how you can improve yourself. Mm-hmm. That's very important, not to stay at the same level. How to, every day that you get involved in trading or investments, you have to improve yourself. It's fundamental. Mm-hmm. And in your life, even if you are employee in your job, you have to improve yourself. It's exactly the same in traders or investors. And that's there are 2 different paths. One is to understand where should be concentrate every time, because in actual facts, we have to find out what matters most. Even in your job, you have to find what is the matters most in your job, in your enterprise, in your company. It's exactly the same in trading. You have to understand the indicators. You have to understand in any time there are different kind of indicators that they tell you the truth. So you have to concentrate on them. The other point is to grow yourself is to get some kind of expertise, because you cannot be you can't be expert for everything. You can't be expert on CFDs. You can't be expert on one sector or invest, or you may have some expertise because you involve in IT market, so you have some kind of expertise, and then you have to improve this. But that's a tricky point sometimes, because you think that you understand, but you really don't understand. But in any case, you have to if you get involved to CFD market, you have to get this expertise to get involved to CFD market or to future market or to stock market. You have to find the rules. And so the other point is, in the life or in trading, to get some kind of expertise. And the third level is about to stay alive in the arena. Because that's the most important. Even the company that you run, you have to see, even if you are a country, you have to see that you have to understand how you can go forward 10 years, 11, 15 years, 20 years. Or in trading, you have to understand that it's not just now, it's about future. So in that kind, there are two ways. One way is to find out how to seize opportunities, how to understand how an opportunity appears, and to get involved suddenly, not to stay beside. You have to act. That's very important, to act immediately if you see an opportunity. And the final pillar, the final step is to have a very, very good risk management strategy, risk management tools. And that means that you always pre-decide. You have to understand and to decide what is the maximum amount of money that I'm willing to lose in each trade or each investment. That's all. What is the maximum amount of money? And the people, human beings, they cannot handle a loss in each trade that is more than, the first step is 2%, and the second step is 10% percentage, or 8%. So, for example, if you lose more than 10% of your money, then you cannot handle your position. There's no way to accept your loss. People, human beings, they can accept only 10% or to lose 10% of their capital, of their wealth. There's no other possibility. If you lose more than 10%, you cannot handle. No way. That's why they lose so much amount of money. Because they say they try they hope that this will gonna return. But this is pointless.
So just to summarize all that you've said, and you can tell me if I've understood it correctly. So there's 3 important pillars that a trader should establish when they're about to get into trading. One is to be very self-aware, understand your level of experience, and understand what your risk appetite is, understand your emotional and behavioral, how you will react in the case of things going bad, in the case of things going good. Just self-awareness is the first.
Exactly.
Yeah.
You got it.
Yeah.
Well done.
The second is then understanding instruments, all the different instruments that exist, what the difference is between a CFD, the difference between bonds, the difference between trading on the stock market, what these different instruments are and how they work as a mechanism for an investment asset type. You need to understand what these are. And then that trickles down into a lot of different details. One is understanding the difference between the US market, the European market, the Japan or whatever, these different stock markets, understanding different verticals. You got the technology, you've got pharmaceutical, you've got production, farming, you've got all of these different things. Understand these things and levitate towards, which goes back to the first point, what you understand. So you might, your industry might be more linked to tech or pharmaceutical, whatever it is. Understand that, and then how these different instruments work. That is an important pillar. And the third pillar is making sure you're not dead in the water when you managing your what you're willing to lose, what you're able to lose. So understanding what your net worth is, what your monthly income is, and how much you're able to invest for the long term. And these percentages that you gave through, I think that's backed by, it's sound advice, if I had to imagine, and it's backed by experience. There is a reason why you're saying if somebody loses 10% of their investment on one trade, one might say, so what? I mean, I still got 90% of my money. But there's more to that, because if you're going to lose 10%, you've got 10 shots and you're dead. So I understand that the 10% is a significant amount, while the majority of people who are new to trading and don't really understand, 10% is a very powerful impact. And if you had to boil down to a single sentence on what risk management means, is how much are you willing to lose on every single trade? How many trades are you willing to take? And draw a line and then disconnect your emotion. If you've lost, your risk and the entrance into that specific thing was wrong. Don't try and recoup the money. Follow your strategy and put these risk numbers in front and just ride the wave, follow the course. Don't get emotional. I think that's
to be more correct. It's not because in portfolio management, I mentioned this as in any portfolio. I mean, you can't handle more than 10% you lose of the entire portfolio. I mean, if you have, for example, 4 different positions or 5 different positions, each position mustn't get lost more than 2%. Total for 5 position.
More than 10.
10, yes. So you have to see it as a total portfolio,
right?
Not as each of the.
Okay, that's
because if you have 5 different positions that each one of them lose 10%, then you lost
half your
50%. And there is no possibility to handle this because it's an emotional. The people and traders, they think all the time that they invest, they can use this word. It's not official. They play. I don't think they play, but okay, they play. But this is not a game that you can play with stocks or CFDs or any other in bonds or any other instruments. It's a play that you play against the other players. Mm-hmm. That's a huge difference. It's a play. It's a game that you play with yourself. It's an emotional play. Mm-hmm. And why it's emotional? Because, and the point is that people, when they are under risk, because they are actually where they are in your life, when you are in a situation, you are depressed, wherever, you are with your friends, with your girlfriend, with a friend, with your colleagues. If you are in a situation that there is a big uncertainty, then you behave and you think in an irrational way. That means that that's why I mentioned that you have to understand, and even if you follow these 7 steps, you still be at an irrational environment because you are under pressure, because you are under uncertain environment, because market is uncertainty. It's so that's why I mentioned, and I said most of all at the top of this pyramid is risk management. You should avoid, because you can handle. You see, if you lose 2% of the entire capital that you invest or you trade, it's nothing. It's okay. You can handle it. You are not in a very huge, uncertain environment. 2% is still that you are in a percentage that you can still not in an uncertain level. But if you lose more than in the entire capital, more than 10%, then you deeply become in the uncertain environment. And if you get in the uncertain environment, in the core of the uncertain environment, then you behave irrationally.
Yes.
That's the problem. That's why I said that. And then when you get some, the other question that most of the traders they do is that what's the amount of capital that I can be I'm okay to liquid my position and to get profit. Yeah, that depends. But you can in trading, my advice is to lock it, to lock your profits. For example, if you get some profit, 2% or 4%, you have to say to yourself, all right, my gain is not 4%, is 2%. The 2%.
Lock the 2,
yes,
and try and arrive.
Yes.
Okay.
And then if it goes to 8% or to 6%.
Lock at 4.
Yes, exactly. But you have to lock it all the time. That's a risk management.
Mm-hmm.
That's you can behave, but you shouldn't think or behave like that. I used to earn, for example, 20%, and because I locked only 15%, I lost 5%.
Yes. No. Yeah.
You have to think rational.
Yes. And also the perspective plays a role. So if you look at, you can look at the perspective of, I've lost 5% because I was at 20, or the other perspective is I've actually gained 15 and I'm happy. Doesn't matter where I was.
Exactly.
So maybe if you can get to the 7 steps, because I don't think you gave us those 7 steps. So we spoke about the 3 pillars.
Yeah. The first pillar is about to
self-awareness, and then you've got understanding the instruments.
The first pillar is about to be prepared. Be prepared means self-awareness,
yes.
To understand the instruments and the financial markets that you get involved. The second pillar is to
understand the instruments.
To improve yourself.
Okay.
To improve yourself, because to improve yourself means that you have to concentrate what matters most, and to get some expertise. That's very important. And the third pillar is about to stay alive in the arena. That means that you have to have a courage not to get involved to opportunities, because some people they are afraid when they see an opportunity. That links to risk management. And they are afraid because they have no structure, they have no risk management tool, they have no risk management plan. That's why the third level is about stay alive. Means that I can get involved to any opportunity that arises, and at the same time, I have a plan to get away if the situation goes wrong. That's the point.
Great. And the 7 steps, or is that basically it in terms of how a trader can be prepared?
Yes, that's my approach.
That's your approach. Okay.
Yes.
So, Nico, at the moment, where are you currently working? We've already been speaking for over an hour here, and I have a hard stop. I need to go, but
let's say some words only about the AI, because I think
of course
it's a game changer.
Yes,
I think it's something that will because sometimes I listen to some people that say that AI is just a tool that we can use it as a simple tool, as a hammer. But it's not such as a hammer. Probably it's a more sophisticated tool, like that algorithmics that we used to have all these the last 20 years. The point is that what I would try to mention is that a tool is something that it has some specific task to implement. So even though we have sophisticated tools and we're programming them to optimize, they have some kind of what if scenarios. But we already say to programming to them to get some specific tasks. All right, that's a tool. AI is not a tool. The AI, and that means that we can react with a tool. Even with a hammer, we react with a hammer.
Mm-hmm.
You see, even with PCs, we react with a PC, with a personal computer. We react with a car. Mm-hmm. We say that we go left, right, we brake, we press the brake and all this stuff. So we react with the tools. That's fair enough. But AI is different. It's totally different. Why? Because AI, with AI, because I all the time I'm using AI in portfolio management, in advising, everything what I do the last 2 years. And I found out that people that they use AI, I'm sure that they found out that with AI make decisions, give advice to you. They create content. So it's a kind, and what I found out is that AI, my prediction, I don't want to make predictions, but my prediction is that in the future, if you implement AI in your organization, in your enterprise, in your company, then AI is gonna behave like the culture of your company. It's gonna adapt. It's gonna be the best friend of you.
Mm-hmm.
It's gonna be the best coordinator, the best. Why? Because we don't. The difference with the tool, that with the tools we react with the tools, with the AI we interact. There is an interaction.
Mm-hmm.
And the other point is that with the AI, it develops itself and it develops you as well. It gives you ideas. It gives you the different ways. That's why it makes decisions and creates content.
It's an interesting perspective. I'm personally, I've referred to AI as a tool. I'll be honest. I have referred to it as a tool. And I view it as a tool, and I'll tell you why. A very sophisticated tool. And what I mean by that is, sure, it's a lot more sophisticated than an algorithm, which You have predefined and told it exactly what to do. And in the context of what we're talking about here, trading, right? And if we had to compare it to an example tool, like actual physical tools like a screwdriver. A screwdriver is there and it does a specific thing. You leverage off of the power of a screwdriver because your fingers aren't strong enough to twist into tight surfaces. So the tool helps you get in, right?
Exactly.
And with AI, why I compare it to a tool is as simple as this. Our brains are not able to process the amount of information that AI is able to. And we get to a decision. So our process in the way our brains work is we've got an amount of information that we're able to process at any given moment in time that are also backed by the way our logic works. Each person has a logic and a process in terms of how you create, get to a decision to then react, right? Our brains are currently used in terms of the data we have in our brains to process and get to a decision. With AI, it's able to do exactly that, but just with a lot more data. So it's a tool to process more data. That's why I compare it to a tool. Just as if you're going to screw a screw into, you need to get that screw into the wall, but you're not able to do it with your finger, you use a tool specific for that task and you get it done. In today's day and age, there's just so much data to process and we're not able to do it. Our brains at the moment. Now, if our brains are capable, that's a beautiful other discussion, I think. And I think, if we had to, through the generations, really work our brains, maybe we would surpass the power of PCs. I don't know, but that's a whole other conversation. As we are today, machines and AI are able to process a lot more data. And that's just my perspective to how I do compare it to a tool. Now, I understand your perspective as well, right? So there's a difference between, having...
Have you ever seen in your the human history or your life a tool that gives you direction?
Yeah.
You get that a tool that gives you that advise you. Have you ever imagined that? I totally agree that what AI does is that it gives what I said. I was in a conference in Dubai recently, and I said to the audience that what AI does is that it gives order from chaos, because there's too many information everywhere.
Yes.
And in the last 20, 30 years, we got so many information and so many noise. So it gives order from all this chaos. I think that what I think it's very interesting about AI is that is in the core of the fourth and the fifth industrial revolution. And what is the fifth and the fourth industrial revolution? What is the core? The core is that we all interact each other. There is a combination and interaction between people and entities. That's why I say that what AI does is that it interacts. That's why it's not a tool for me, in my perspective. It's an entity. Because a company, it's an entity because you can interact with a company. A person is an entity because you can interact. If with a person you cannot interact, you say that sometimes that this is not a human being, this is a tool, just a tool, because it cannot interact. If you interact, that you are a human being, either you are a human being or an entity, a growth entity, because you can interact. And AI is at the core of the industrial revolution, of the fifth and the fourth industrial revolution, because these revolutions, the core of this revolution is interaction and combination between different kinds of people and entities.
Right.
And the interesting point is that this entity, it makes decisions. And that's very important. Because I think, as far as I know, it's the first time in human history that we invent something, an entity that makes decisions different, that we, as you mentioned before, you pre-organize, you predefine what the task tools, you predefine what tasks they should do. Robots, when they are in industry, they know that they have these what-if scenarios, all right? But they can make some kind of optimization, but they never get some decisions. Mm-hmm. That's the huge difference.
So you mentioned you use AI for your actual work, and is that specifically in composing the articles that you?
Oh, I meant portfolio management.
Portfolio management,
yes.
And how do you do?
It's amazing.
Yeah.
Yes, and I think I believe that first of all we have to respect our clients. We have to respect people. That's why I mentioned so much time that you have to help them. It's about the meaning that we give. It's not about money. It's about all these people. They try to find some kind of meaning. Even cryptocurrencies. Some people they get involved on crypto or blockchain, which is another huge challenge in the history of economics and human history. But these people, they invest on this because they found some kind of meaning. It's a new reality. So in my new book that I write is about, I'm trying to find what the path that big challenges follow to be a great challenges. And most of them, they follow exactly the same path. All great challenges like AI, as you mentioned, or probably cryptocurrencies or blockchain. Blockchain is a huge challenge because what they do, all the great challenges, internet, was a great challenge, the industrial revolutions, democracy, whatever you think, even your child, it's a big challenge. It's a great challenge for you. Why? It's a big challenge because it creates a new reality. And you see, even Donald Trump now wants to create a new reality, a new normality. And to create a new normality, a new normality that people and entities either wants to, they are actually a new normality that is established. It's based on a common ground of values. And these common ground of values, people and entities either are willing or obligated to defend no matter the cost. Mm-hmm. So the point is this AI, if it creates a new reality that people and entities will defend no matter the cost, then this way the AI can become a great challenge. It's exactly the same as internet. Internet became a great challenge because people and entities, they are obligated or willing to defend this new reality that made no matter the cost. And the interesting point is that if people defend, they are willing to defend a new reality, a new normality, a ground of values, then their perspective for this challenge is that this is a great, if they want to, that's a great opportunity. If they are obligated, that's a big risk. It's even in your company. If people in your company are obligated to do something, they are afraid. They found that it's a big risk not follow this new reality. If they want to, they're willing to, this new reality it's a great challenge.
Right.
And every reality, any reality I think is based on three fundamental pillars. It's about knowledge, activities, and beliefs. Because knowledge is about what's the common truth. Activity is about what were necessary to do. And beliefs is about what we must do.
Right.
What is the priorities. So the combination of these three pillars makes a new reality. So we will see in the future that AI creates new forms of knowledge, new forms of activities, new forms of beliefs. You will see that the new truth arise. new activities get started and new beliefs prioritize this new reality, then we're going to have a great challenge. And I do believe that we are at the beginning of a great challenge.
I agree. Nikos, let the audience know your upcoming books or your existing book, where they can find you.
On Amazon, my name, if you print it in my name, but I inform you when I publish it. They can find my book, my existing book in Amazon as well.
What are the names of the books?
Financial Economics and Strategic Investment Management Undercover.
Great. Nikos Akkizidis.
Yes, exactly. Akkizidis. Nikos.
Thank you,
Nikolaos.
Nico. Yes, thank you, Nico, very much for your time. An insightful discussion over here.
It was a great pleasure. It was very good to communicate. Actually, all these years, I would like to communicate with people that I respect. Traders, we need to respect them. We need to give not the pathways, not the tools, the pathway to think, to adapt ourselves, to be like I will mention again, to interact.
Sure.
That's the core. And we're very lucky that days, because after 2000 we're all interacting with each other, and that's amazing. But we have to find, as I mentioned before, the priorities, what matters most, what's our expertise, to protect ourselves, to find ourselves.
Amazing. Thank you, Nico. And
thank you very much.